But first, joining us to talk about the market today, Jeremy Siegel, Wharton finance professor, and still with us, Keith Bliss, CEO of IQ Capital USA. First, Mike, though, to you to reflect on the sell-off that we saw. It was worse this morning, but we still closed lower, more than 450 points.
The reflex was just to reduce exposure, and we were able to say for the past 2 weeks that there was very elevated sentiment and the stretched market and positioning was very aggressive. This was the check on that. Now, it didn't seem, though, over the course of the day as if it was really high-intensity rush for the exits. It really was just, let's skim some off the top. The major indexes lost a similar percentage. I'm looking at a stock like Alphabet, which was down, almost 3% or on not very heavy volume, and it's not even in China, right? So it obviously was a lot of the more crowded big growth names that got hit, along with some of the cyclical. So I think we're still on alert because that global cyclical upturn we've been waiting for might not happen on time right now, and that's the issue the bond market's dealing with.
And Mike, the broader market is still in an uptrend, and unless it pulls back, what amount from here?
It's still certainly in a longer-term uptrend. I mean, if you can, people are saying down to like 3130 or 3150 on the S&P, so a few percent down from here. It's still in the zone of this is the kind of pullback you should expect to have after a strong rally. Not going to feel like that if we get it. It's going to feel like it could be something worse, but that's the reality of what the chart says.
Professor Siegel, what is your level of concern for the market and the economy on these coronavirus headlines?
Well, I actually welcome a little bit of this pullback. I've been on your program saying that I thought that in the early part of January, the market was getting dominated by momentum players that were just riding the trend. We had an incredible string of days where, I think this is the first one. We've had a 1% move in the S&P in months. And it's good to get, as we said, a reality check. I mean, there was really nothing going on that could keep on forcing that market up at that level. So in a way, I think this is a healthy check. Now, can we get back on that train? Yes. Sometimes a little pause, and then people get their confidence back, say no worry, and then we're back on that train. We'll have to see at this particular, juncture. Stocks are fully priced, which means things have to go right, which means if things don't go right, you're going to get reactions like this.
To what extent, Professor, are they fully priced still? Talk us through some of the numbers.
Well, when you have S&P basically selling at 19 to 20 times this year's earnings, historically, that's definitely on the high side. And in the post-World War II period, the average has been about 17. Now, we are in a low-interest rate environment, which is certainly good, but we're also, 12 years into an economic expansion, so you have two sides. This is a fully valued market. Things have to go right. We've got, 25% of the firms reporting earnings. They're okay. They're not spectacular. Guidance isn't spectacular. I didn't see what was really driving the market straight up in early January, except, relief that the worst of the trade wars was over the hump, and at least that was out of the way. But when you're priced like this, a little stone in the way, such as the coronavirus, you're going to get a stumble. And in a way, that's the reality check that you have to expect.